Once I mastered ICT daily bias, I was able to make $2.5 million from trading in less than 4 months, and I'm about to pull back the curtains on my entire process so you too can call the markets with ease. Before I created this two-step system to finding daily bias, I overthought every trade and struggled to find consistency. But once I learned this, I instantly became profitable. As you can see, I made $2.5 million in a single payout, and here's the proof. But what really matters is how you can copy my exact process and save years of losing money and frustration. And that's the exact goal of this video, to give you guys the system I wish I had when I first started. It took me 10 years to become profitable, but with this information, my goal is for you to do it in one or much faster. So the first step of this process is to simplify daily bias so even a complete beginner couldn't mess it up. So let's get right into it. This was the single most powerful breakthrough in my trading career, and I want you guys to imagine what your trading would look like if you knew the overall direction. So entry models are actually really easy. It's knowing which ones to take and which ones to avoid. So if you knew how to find the best trades, would you be a profitable trader? And the reason you've been struggling up until this point is because you've been misguided by all these gurus who don't even trade. Now, there's only 2 steps needed to find daily bias, and you don't need to confuse yourself. We're looking for premium and discount and power of 3. So what is premium and discount? So very quickly, I'm going to go over just our daily time frame on NASDAQ and kind of just plot out our daily swing points. So when we're trying to find swing points in the marketplace, right, and a swing point is characterized by a 3-candle pattern, right? For a swing high, we have a lower high on one side and then a lower high on the other side. So that creates this swing high. And then for a swing low, we have a higher low on one side and a higher low on the other side. Okay, and then we don't get another swing point until here. So once we get these swing points put in place, we can very clearly determine a range, which we're going to use our fib retracement tool, and just draw out, anchor your fib from the swing high to the swing low. Now, anything above 50% is going to be premium. Well, if the market is poised to go lower, and then anything below 50% is going to be discount. So when we're trying to find trade ideas and trying to determine our overall bias, right, we're using swing points and we're using premium versus discount to try and put ourselves on side with the most likely movement in the future. Okay, so after we get specific swing points, maybe we take out a specific swing point and fail to close through it, and then we get a swing low, which provides the following day bullish price action. So this is a case for your study where you guys can go in and actually measure these candles, and you can even use fib retracement tools on daily candles themselves. So if we just grab a single daily candle, right, if we draw out that previous day's high with the previous day's low, and if we're expecting bearishness, you guys can see the reaction that we're getting inside of these wicks. Okay, so this candle here, right, you anchor our our daily high to our daily low, and then we're using that as our dealing range. Okay, so that is providing us with our premium and discount. Now, when it comes to premium discount, right, we have all these other ICT PD rates that maybe you guys know, maybe you guys don't know, right? We have liquidity rates, we have fair value gaps, breakers. All these things come after we try and understand where our direction is. So if I had to very clearly draw out, my flowchart and my process of understanding where the market is going to go, it doesn't go to trade setups first. And that's where I think a lot of traders fail, is that they lose sight of the high time frame direction. So when it comes to determining what we're going to do, we're going to try and predict, understand high time frame premium versus discount. And then once we have a good understanding of where this might go, okay, so let me just draw an arrow. This is going to create our high time frame bias. Right, so if we are in a premium and I'm expecting the market to go down, now all of a sudden I have a bias. Then once we have that out of the way, then your bias leads into trade setups on the low time frame. Okay, so the most important thing is really understanding, okay, did yesterday create a higher high or higher low? Do we respect the previous day's high? And did we trade into specific PD arrays? So like here, for example, let's say we just have these 2 days. This still created a lower low, did it not? So this day created a lower low as well as a lower high. So we are still in a bearish market environment. But the fact that we ran out the previous day's high does not necessarily mean that we're going to turn bullish yet, right? Because we are still respecting other levels in here, like this daily fair value gap that's resting just above that previous daily high. Okay, and that's when we look for a liquidity raid. So everything from my perspective will start from high time frame premium discount. So yes, you can find swing points, whereas you can find swing points here. So maybe you're drawing your fib from this high to this low, and then you're getting swing points in here, right? We get a nice dip here. It doesn't reach that old low. And then it's kind of just chopping around. Or you can use the actual candles themselves. So if you're looking to be bullish on a specific day, or bearish on a specific day, you can just draw the previous day's high to low. Okay, if we're trading in premium and the market's going to go lower, well, anywhere up here is a better sell than if you're trying to short it down here. So all of this is to say that the high time frame direction will keep you in line with the overall trend. That way you're not being faked out by a lot of these low time frame trade setups. Okay, so if I see a setup on the low time frame, maybe it's a bullish fair value gap, but my high time frame bias is lower, I'm essentially avoiding those trades. Now, the next point that I want to get into is power of three. So what exactly is power of three? Well, very quickly trying to explain this, power of three basically happens on every single candle, but for the purposes of this teaching, we are only talking about the daily time frame. So each one of these daily candles, right, has an open, has a high, a low, and then a close. Right? Every single one of those candles has this signature in it. So let me just actually draw this out so you guys can actually visually see it. So we have an open, a high, a low, and then a close. And then if you're bullish, right, you have an open, a low, high, and then a close. Okay, so this is how the market really is essentially moving. So here we have open, high, low, and then the close. So all of this is leading us into an understanding of how we're supposed to position ourselves inside of a daily candle. Okay, so we have our high time frame bias. We have a level where we're expecting the market to trade to. Now it comes down to execution. How do we execute within that daily time frame? So let's drop down into a low time frame just so I can show you guys what I would be looking for if I have a predetermined bias. So essentially what I'm looking for is if I am bearish or bullish on a market, I want to see the market trade below or above my opening price. Now, if I just take a look at this opening price here, and I always use midnight as my delineation, okay, this candle closes bearish. And what I'm looking at is, if I'm trying to get short, I'm looking for any prices above the open to position myself. Because if I know I can short above the open, it's a much better price fill and much better risk to reward than if I were to short it down here. Okay, so a lot of people get caught off guard by trying to short into weakness and buy into strength. And really you have to try and flip your mindset to doing the opposite. So as the market's going higher, if you're bearish, we're looking for bearish setups to appear as the market's trading higher. And vice versa on bullish days, this is a really good example, is if we have an open here, what I'm looking for is that run lower, because I know anybody that's trying to position long is going to be in a much better position than if they were trying to go long above the open. Okay, there's much less risk, there's greater risk to reward, and you're not chasing price as it's running away from you. So now that you guys understand on a very basic level how I use premium discount to understand my daily bias, neither of these steps actually are going to work if you don't understand timing of your trades. But first, if you struggle to find consistent trade entries, I made a simplified guide that breaks everything down, how I find the best trades, and I'll leave a link for that in the description. So when it comes to timing, a lot of people can determine a bias, but they don't know actually when to trade their specific setups and how to avoid specific trades when context doesn't align. So for this specific example, let's say if I have a bullish bias on a specific day, and I know that I have CPI tomorrow. So CPI releasing on Wednesday, usually I'm not trading until after the news release. Now, this is where a lot of traders, they take losses because they just don't understand the context and they think that daily bias is really going to carry them to the promised land of profitability. Timing is extremely, extremely important. So if I have a bullish bias and we have CPI tomorrow, I'm looking for trades post news. Now, that bullish bias, it needs to have some type of framework and it needs to make sense. But on the CPI release, we take out the buy side liquidity, which is the previous day's high. Now, from a timing standpoint, this just doesn't make sense when I'm bullish. When I'm bullish, I actually want to see manipulation lower, maybe even the news release spike lower. That way I can position myself long, right, taking out old lows and then trading till old highs. So having a bias isn't the only thing that's going to make you profitable. It's knowing when to use that bias in the proper way and timing it properly. Because I can show you multiple situations where, if we don't trade below the midnight open and we're trading at a specific level when I sit down in front of my charts, like this, for example, let's say if I did have a bullish bias, but we don't get that manipulation lower and the market is trading up here into a premium, right? So that premium might be a bearish order block, a bearish fair value gap, previous day's highs, something like that. That means I'm basically just waiting on my hands because the time alignment is not making sense. And this is where I find myself to sit out of a lot of trades because a lot of the context doesn't make sense. And recently, a lot of the context in the markets hasn't made a whole lot of sense. Like we've been chopping around. The market is moving when I'm not expecting it to move. It's printing intraday highs and lows. At times, I'm not expecting it to. Like here, we're printing intraday lows during London session. And I'm expecting volatility during New York. So if New York is already trading at previous day's highs, I'm putting myself at a major risk because my time is incorrect. Okay, if we're trading above a previous day's high, and this is 9 a.m., right? If I have a bullish bias and we're trading up here at 9 a.m., that is not a good sign for me to go long. So I need time to align with my bias, and that is just as important, if not more important, as actually having a bias in the first place. So let's kind of break down everything that we learned. So our high time frame bias is a result of understanding premium and discount, and then you have an expectation. But then the final piece of that is timing. So we analyze the high time frame to understand premium and discount, where the market might go on the daily time frame, understanding PO3. Okay, so if I just look at all these charts, and this is typically what I like to do at the end of the week, I try and figure out, well, when is the market likely to trade lower, and when is the market gonna set up for me to be able to position myself properly, that way I can take advantage of a specific move. And if my expectation of PO3 does not align with time or price by the time I sit down in front of my charts, this is how I avoid just blindly aping into trades, even though I have a strong bias. So if I have a strong bias that the market is going higher, but the time frame alignment is not meshing well with that, I don't really have a trade because I can't get the proper risk to reward on. We're taking out previous day's highs, right? My bias is bullish. There's so many different ways to avoid taking specific trades when that timing does not align. And a lot of that comes from analyzing the calendar, having a plan in place as far as when you're expecting for each week and each day. And when there's certain things that just don't make sense to you, like we're taking out a previous day's low when we're bearish at the time of your trading session, maybe the moves already occurred during that specific day and you should sit it out and wait for the next day. So I know this was a quick video, guys, but this is a very important lesson that I think a lot of people overlook when it comes to finding a bias and trading the bias. The timing aspect of your trading makes a heck of a lot of difference. And if you sit down in front of your charts and the markets have already moved to your targets, maybe just come back the next day. So I hope you guys enjoyed this video, and I'll see you guys in the next one.